This is the Daily Market Comment for Thursday, January 20th by Mario Hadjikyriacos. I'm Christina Marujos, and thank you for joining us here at XM.com. It has been a stormy week for global financial markets, with riskier assets such as equities taking a beating at the hands of rising interest rates. The Nasdaq closed another session sharply lower to officially enter correction territory. The striking part was that even a pullback in U.S. Treasury yields was not enough to stop the slide on Wall Street yesterday. On the bright side, the mood has improved a little on Thursday. A cautious sense of relief is coursing through global markets after the People's Bank of China cut its mortgage lending rate, sparking hopes that tighter monetary policy in other economies will be at least partially negated by China going the opposite direction. The question now is how much longer this correction will persist. The good news is that there will come a point where the spike in rates will become self-correcting, and we may be nearing that point. Once U.S. yields reach a sufficiently high level such that foreign investors can hedge their FX exposure and earn returns much higher than local bonds, there will likely be enough demand to put a lid on Treasury yields and thereby calm the stock market. Similarly, Fed expectations have already come a long way, and betting on even faster shock and awe hikes seems unrealistic here. This suggests we may be approaching peak fear in the near term, especially if the tech heavyweights report solid earnings next week. Over in the FX space, it was a relatively muted affair. The pullback in U.S. yields knocked the wind out of the dollar, yet the retreat was minor. Meanwhile, the Australian dollar received a boost after the nation's unemployment rate hit a 5-decade low. But the real action has been in the commodity sphere lately. Oil prices continue to defy the sour mood in equity markets, focusing instead on the COVID endgame as nations prepare to downgrade the disease to an endemic and the potential for greater supply disruptions if Russia pulls the trigger on Ukraine. The price action in gold has been exceptionally bullish too. Bullion blasted above the $1,830 region yesterday to hit a 2-month high, capitalizing on the faintest of pullbacks in real yields in the dollar. This screams of a market that wants to go higher, as gold took almost no damage while yields soared this week, but traded like a rocket the moment they retreated. As for today, the spotlight will fall on the minutes of the latest European Central Bank meeting. In earnings releases, all eyes will be on Netflix. Thank you for watching today's Daily Market Comment here at XM.com.